Waiver of deficiency, possible relocation check at closing, $3,000 to $10,000. The $10,000 number originally came from the Home Affordable Program, which, as I stated earlier, expired. That had a short sale leg. It was Home Affordable Foreclosure Alternative. It was a great short sale program. Always got waiver of deficiency. If it was owner occupied, the homeowner could get a $10,000 relocation check. If there was a tenant there, they could get a $10,000 relocation check. And it always came with a waiver of deficiency, and they offered a large amount of money to junior mortgages, way more than you see offered now. It's $12,000. And they had to waive their deficiency by accepting the 12 grand. So you hardly ever had them not accept. It was a really good deal. Unfortunately, that expired. So $3,000 is the norm these days. There's a couple straggler banks that are still going with the $10,000, which is great for the homeowner, but it's pretty rare. These days, it's usually $3,000. When I talk to homeowners, I almost never bring up relocation unless they ask about it, because I can't guarantee going into the transaction that they're going to be approved for it. They have to be eligible depending on the guidelines for the investor that owns the loan. They may not offer relocation at all, and if they do, there may be eligibility criteria that the homeowner may not meet. So I don't want to set an expectation that they're going to walk away with $3,000 at closing and then they don't get approved. That's the only thing they're thinking about, is they didn't get the $3,000 I told them they were going to get. But I don't recommend giving them that kind of carrot, because it set an expectation that might not be met.
And they will hold on to that.
Be a surprise that they get.
They will hold on to that through the whole transaction. It will be the thing they ask about every time you call, every time they call us. Am I getting my $3,000? So it's definitely there.
We had a seller just decide not to close because their agent promised them that they were going to get a relocation check.
It's definitely.
Their investor didn't even have a program that there was ever going to be one.
As an agent, so that we didn't touch on this before, but as an agent, you should definitely never promise a relocation. You should also never tell a homeowner they should not make their mortgage payment. That's not something that you should ever mention to them. That's not something that we even do. Sean has to do it.
We can, as long as I inform them that if they don't pay, they may.
Correct, but there's a lot of things that go along with if you don't make your mortgage payment. So as an agent, don't put yourself in a risky situation. Don't tell your homeowner to not make their mortgage payment.
Yeah, but relocation is possible. They're able to qualify for a mortgage sooner than if they get foreclosed on. Depends on the type of mortgage they're looking to get in the future, but could be, what is it, minimum, John, 2 years now for FHA after a short sale? And then if you get foreclosed on, it's what, 5 to 7? Yeah. So if that's something that they're thinking about, that they're planning on, I want to be able to buy again in the future once they get out of this problem, how long it's going to take them to qualify?
We see that a lot in divorce situations.
Yeah. Avoid foreclosure in the deficiency judgment. We talked about the deficiency judgment a little bit. We're going to get into that a little bit more. And then income taxes are a concern. So we have a lot of people, they do their own internet research, and they're like, oh, if I do a short sale, I'm going to pay taxes on the amount that the bank forgave. That's true. That's a possibility, although most people don't end up having to owe taxes as long as they talk to a knowledgeable accountant. There's one definite, a second possible exemptions to owing taxes on debt forgiveness. So the way the IRS code says is somebody gave you money, but you had to pay it back. That wasn't income. Now they say you don't have to pay it back, so that was income. So now you have phantom income from this debt forgiveness, and it's treated as ordinary taxable income. It gets added to your adjusted gross income if you don't qualify for an exemption. The exemption that most homeowners that are needing to do a short sale qualify for is called insolvency. If they have a negative net worth, meaning more outstanding debts than the value of their assets, they can use the insolvency exemption not to owe any taxes on debt forgiveness. If they don't have a negative net worth but have a very low positive net worth, they could potentially reduce the amount of taxes that they owe but not completely eliminate it. They really need to talk to an accountant because there's a pretty detailed financial calculation they have to do. And unfortunately, for the insolvency calculation, they include retirement savings as an asset. So people that have significant, like 401k, oftentimes will owe taxes because they won't qualify for insolvency. The other possible exemption has expired several times over, keeps getting extended after the fact. It has not been extended for this year yet. There are bills out there, so who knows whether they'll extend it again. It expired the end of 2016 is the last time it expired, and they didn't renew it until February of this year. They made it retroactive to cover last year. That was the latest it had been extended. The previous 2 times it was extended, it was done in December of the year where it had expired the year before. So you went through the whole year not knowing if it was going to be extended or not, and then last minute it was extended and made retroactive. This year was the first time they did it after the tax year had already started. It was actually included in the bill that ended the government shutdown. So we don't know. it's probably not going to decide again until December of this year whether they extend it or not. That particular exemption, I think most real estate agents have heard of, was the Mortgage Debt Forgiveness Act. And it was basically, if you did a short sale on your primary residence and the mortgage was a purchase money mortgage, then you could claim this exemption and not owe taxes on any debt forgiveness from a short sale or whatever else, if you did deed in lieu or if you got foreclosed on and the bank decided not to pursue the deficiency. So it had to be purchase money mortgage on your primary residence. Primary residence is you lived there 2 out of the last 5 years. Purchase money mortgage is the mortgage you use to purchase the property or improve the property. If you refinanced, but just for a better rate and you didn't cash out, that still qualifies. If you got a home equity line of credit to do a whole bunch of repairs to the house, that still qualifies. So that exemption a lot of people used, especially if they didn't qualify for insolvency, but they met that requirement. But it's expired. We don't know if it's going to be extended again or not. If it's not, we're left with just the insolvency exemption. So sometimes you hear from people, well, why am I going to do a short sale? I don't know taxes. I'll just let them foreclose. Foreclosure doesn't get rid of the taxes. Best case scenario in the foreclosure is the bank decides not to pursue the deficiency, in which case it's forgiveness of debt. You still get a 1099-C for the debt forgiveness. So just letting it go to foreclosure doesn't take care of the possible tax consequences.
So they'll either owe taxes or there's a possibility of a deficiency judgment.
And they come after them for the money.
And they come after them for the money. So either way, they're probably going to have to pay. So it's definitely something that is not going to be in their best interest if they just say,
Yeah.
it doesn't matter, I won't owe the taxes if I just let them
They can't
foreclose.
just put their head in the sand. The problem's not going to go away. It's just going to transfer to the IRS.
And that's worse. Honestly, some of these IRS liens are worse.
Yeah. Bankruptcy is the one thing that they can do if they're not going to be able to avoid the taxes. Of course, they have to qualify for bankruptcy. We had one client several years ago that they had a successful business for a long time. The business went under. They had like a $500,000 house and had like $800,000 worth of debt on it. So even if it sold, there was going to be like $300,000 in debt forgiveness. And they were on Social Security at this point. They had spent all their savings trying to save the business. They had like nothing left. So they were a perfect candidate for bankruptcy. I'm sorry, I said that wrong. They had a bunch of retirement savings, but they didn't have any like regular money. They didn't have much for income. They were only on Social Security. So their Social Security and what they had for retirement is the only thing they had to live on. Well, they wouldn't qualify for the insolvency exemption to get rid of all the taxes because of their retirement savings. Your retirement savings is protected in bankruptcy for, the last I heard, I think it was $1 million. Hey, Larry, you know if that's changed at all? Protection for retirement assets in bankruptcy, is it still $1 million? I think so. Yeah. So they get up to $1 million in like a 401k, and they can't do anything with it in bankruptcy. They can't make them liquidated. Versus if they had that money in a savings account, bye-bye, it's all going to your creditors. So for those homeowners, it made a lot better sense to go spend a couple $1,000s to a bankruptcy attorney and file bankruptcy and discharge the mortgage debts, which means banks couldn't come after them for any money, and now there's no debt forgiveness to be taxed on. And then that way, their retirement savings was fully protected, and they couldn't come after them, the bank couldn't come after them for any money after the fact. Now, so they did bankruptcy, and then we moved forward, we tried to do short sale. Unfortunately, at that price range and that time in the market, they couldn't get an offer on the damn place. It did end up going, I believe it did a deed move, if I remember correctly. But in that homeowner's circumstances, if we hadn't gone over everything with him and just like plowed forward with a short sale, they would have had a huge tax bill. We went over it with them, we put them in the best position, guided them towards the best position. Obviously, they seek legal advice from an attorney for bankruptcy and whatnot, but that made best sense for them.